Welcome back to the Trading Desk. Right now, what we'd like to do is take you to the streets of Central Oregon. We're going to have this be a regular part of our show. What we did this time was took our cameras to the streets of Bend and asked people what their best idea for an investment for the following year would be. If we gave you $100,000 today, where would you invest it over the next year?
In Bend, Oregon.
In what relation would you buy?
Real estate.
So where should you put your money? Do you stay with the stock market, or do you go buy a second house, something like that?
Probably whether or not real estate is still a good investment.
Still real estate.
Still real estate. What's your best idea?
Real estate.
Start trying to invest in property.
Okay.
Just because of how much it's starting to go up, and probably out more towards Prineville.
And what's your best investment idea for 2007?
Real estate.
Real estate. May I ask why?
Seems to have done good for me so far.
Probably real estate.
I would probably invest it in some real estate, something I could rent.
So a rental property?
Rental property.
And do you own rental property today?
Not right now,
okay.
no.
Have you ever?
No, I haven't.
I think you can see from that tape that we just ran, which we happened to film back in late spring here in Bend. It was a beautiful early March or late March, early April day. But what I found interesting out of that tape was the consistency. And we spent almost 2 hours filming people on the street, and we asked an open-ended question. People could have responded any way they liked. Right. What did they respond, guys? What did they want to invest in?
Real estate.
Real estate.
It was interesting to say, what is your best investment idea for 2007? And like you said, leave it that open-ended.
It was totally open-ended.
Anything.
Stamps. What do you want?
Right.
Picasso's.
Exactly.
What do you buy?
Everybody wants real estate. We're a few months away from that now, so I think the consensus around town has changed a little bit. Things have slowed down, and people aren't as enthusiastic. But I think it's a good thing to notice that when everybody is leaning in one direction, you're definitely not going to get the opportunity to buy low when you're competing with that many buyers.
The way that I like to look at ideas for trades is when everybody knows. Everybody knows Crocs, right? Everybody's buying Crocs right now, and this is another name. You can see the same thing happening. Right. It's going up and up and up. It's not going to go up forever, but right now it feels like it is. And it was the same thing with real estate. But the reason why real estate went up, again, had nothing to do with fundamentals. The only fundamentals that mattered were liquidity, and we come back to this equation.
Lending standards.
All
that free money.
Was
all that free money
open, so that money had to go somewhere. Banks were saying, you know what, we'll lend it to anybody because all real estate does is go up. But that's not the same anymore.
And in one respect, these people were right. I mean, if I had gone back and bought just a boatload of real estate 5 years ago, I would have made a fortune.
Right.
But
it wasn't obvious to everybody back then.
Exactly.
But did you sell when you should have sold?
Exactly, and that's the thing. Buy low, sell high is a popular cliche because it's true. I mean, if you want to buy way back when nobody else wants to,
that's when you want to buy when it's liquid.
When everybody's trying to buy and competing with you, that's the time to sell.
And it's also the time to start selling.
Exactly. Right. So
I think one of the things, though, we have to differentiate. If we're talking about real estate, we're talking about someone who's buying a house because they're going to be here in town for the next 15, 20 years. Someone like myself, probably like all three of us. Or are we buying it because we hope to get rid of it in 2 years? Right. And I think that's where the difference lies. I mean, I think if you're buying it from an investment standpoint.
I think there's three different types of buyers and then permutations and stuff. There's people who buy I need a place to live. Then there's people who buy for investment reasons and people who buy for speculative reasons. Right. Speculators are the most aggressive risk takers out there. They say, I'm going to go buy this house and hopefully I can sell it 6 months later and make $100,000.
I would compare speculating in real estate to buying penny stocks. Yes, they do go up.
Absolutely.
I wouldn't recommend anybody to buy a penny stock.
You have the biggest potential rewards, but you also have the biggest risks.
Absolutely.
But investors, will come in and they'll say, okay, I'll look at real estate like any other investment. Yeah. I can go buy a 10-year treasury note that's risk-free. I'm not going to lose money no matter what happens. And I can get 5% on that money. So if I'm going to go buy a house that has some risk, I want to get at least a 5% rate of return to make it a compelling investment from an investment standpoint.
And then you have the appreciation component over years if that were able to continue. If appreciation went at 4%, which is a great return on real estate.
Yeah, I mean, which means if you buy a house for $100,000, you want to make at least $5,000 a year in the rental income.
Minimum.
That's the way an investor looks at it.
Right.
And I think there are permutations of both. There are people that go in, I want a house, I would live in a house, but if I can make $100,000,
But I think what we saw is unprecedented in our lifetimes, and really, I think even I'd have to go back, but I don't think even in the 20s money was lent the way it was lent during this credit liquidity openness. I mean, we were lending money to, no offense here, but 25-year-olds with no credit. were lent money,
no money down,
110% of the value of the home.
And they're borrowing multi-millions of dollars with no job. You know, there's documented, that's happened. I think that a good point to make is that the fixed income market, or the stock market, the U.S. stock market is a $15 trillion market. The fixed income market is a $30 trillion market. It's twice as big as the stock market. So you get some, bubble-ish things going on in the fixed income market. It's going to affect the economy. It's going to affect, asset markets way more than just a stock market bubble is. We've had this bubble in fixed income that's just been bigger than anything.
Society, because it is more than it's where you live. It's where it's all those things. With that being said, I think the key thing investors need to look at on any investment again is where are you in that fear versus greed cycle, and everything goes up and down. You call it a bubble, whatever you want, but there is an up and there is a down in cycles. We got way beyond the standard deviation of the greed side, way beyond. And we are now just coming what I would consider the fear denial stage, and we need to go all the way down to desperation, blood in the streets before this thing will rectify
Right.
itself.
You're not going to have people think, oh, well, it's going to slow down and then it'll get better. That's not the bottom of a market. The bottom of a market is when you talk to the guy who bought 3 houses and he's fire sale all of them, and before foreclosure, and he says, I never want to hear the words real estate again as long as I live.
When there's blood in the streets, then that's what it comes back to.
But that's what the average person can use to gauge it. I mean, obviously we come out with statistics. They're not as easy to get a hold of. They can think of, am I buying low? I mean, you can gauge that. Or am I buying? Am I selling
Speaking of buying low, selling high, what I'd like to do now is take us to the break. When we come back, we're going to talk about our fantasy finance section, where we come back with our ideas of this episode, and we'll come back with those ideas.